3 weeks ago, my phone rang at an unusual hour. It wasn't a journalist. It wasn't a market analyst. It was someone I hadn't spoken to in over a decade, a former senior official who spent the better part of his career deep inside the architecture of the United States financial system. The kind of person who doesn't call unless something is seriously wrong. I picked up. He didn't say hello. He didn't ask how I was doing. The very first words out of his mouth were a question. He said, "How much cash do you have outside the banking system right now?" I told him the number. The line went dead quiet. Not the kind of pause where someone is thinking of what to say next. The kind of pause that feels like weight pressing through the phone. Then, after a few long seconds, he spoke again. And what he said is the entire reason we're having this conversation today. He said, "You should probably double it before April." Now, I want you to think about that for a second. This is not a panicked man. This is not someone trying to sell you something. This is someone who spent decades watching how money moves behind the scenes. Someone who has seen financial systems crack from the inside. And he called me out of nowhere after 10 years of silence just to say those 7 words. When a person like that speaks with that kind of calm certainty, you don't scroll past it. You sit down and you listen. Welcome to Global Updates 24. And today we are diving into something that almost no mainstream financial channel wants to touch. We are going to talk about the real structure of the banking system, the hidden pressure points that have been quietly building for years, and the single most important question every retiree in America needs to answer right now. How much of your money is truly safe, and how much of it is sitting in a system that carries more risk than the headlines will ever admit? This is not about doom. This is not about stuffing cash in your mattress or buying a bunker. This is about something far more practical and far more powerful: financial resilience. The kind that lets you sleep at night no matter what the market does tomorrow. So stay with me, because over the next few minutes, we are going to cover things that most people only find out about after it's too late. Let's start in March of 2023, because what happened that month should have been a wake-up call for every single person with money in a bank account. And for most Americans, it wasn't, because the news coverage buried the real story underneath a headline that made the whole thing sound contained and resolved. A major U.S. bank collapsed, not in slow motion, not over months. It happened in roughly 48 hours. Billions of dollars moved out through mobile apps and online transfers before regulators even had time to react. The government stepped in over a weekend, guaranteed deposits, and within days, the story had already faded from the front pages. Most people moved on. But here's what the headlines never fully explained. That bank didn't collapse because of fraud. It didn't collapse because of reckless gambling or bad loans, the way we saw in 2008. It collapsed because of something so basic, so widespread across the entire banking system, that understanding it should genuinely change the way you think about where your money sits right now. Here's what actually happened. During the years when interest rates were near zero, banks across the country bought enormous quantities of long-term government bonds. These seem like the safest possible investment: government-backed, stable, reliable. But then the Federal Reserve did something it hadn't done in over 4 decades. It raised interest rates aggressively, and it did so fast. And when interest rates rise sharply, the market value of existing bonds falls. A bond paying 2% interest becomes nearly worthless in comparison to a new bond paying 5%. No investor will pay full price for the old one, so the value drops. And suddenly, banks across America were quietly sitting on hundreds of billions of dollars in what are called unrealized losses. paper losses on bonds they bought when times were good. Now, under normal circumstances, this stays invisible. Banks can simply hold those bonds until they mature and eventually collect the full value. The losses stay theoretical. But, and this is the critical point, that only works as long as depositors leave their money in place. The moment people start pulling funds out quickly, the bank is forced to sell those bonds at the lower market value to raise cash. And in the age of mobile banking, that process can happen terrifyingly fast. That's exactly what took down that bank in 2023. And here's what should concern you deeply. The unrealized losses that triggered that collapse were not unique to that one bank. Official federal data confirmed that financial institutions across the United States were collectively holding hundreds of billions in those same types of losses. The problem didn't disappear, it was absorbed. It was managed, but it did not go away. Now, layer on top of that a second pressure point that gets even less attention in everyday financial news: commercial real estate. Think about how dramatically the working world changed after 2020. Remote work, hybrid schedules, companies downsizing their office footprints permanently. The result? In major American cities like San Francisco, Chicago, and New York, office vacancy rates have climbed to levels that would have been almost unimaginable just 10 years ago. Entire floors of buildings sit dark and empty. In some districts, nearly 1 in 4 square feet of office space is unoccupied. When buildings sit empty, rental income collapses. When rental income collapses, the value of those properties drops. And when values drop, the loans attached to those properties become extremely dangerous. Here's the part most people don't realize. Many of these commercial real estate loans were taken out during the low interest rate era, when borrowing was cheap and property values were climbing. Those loans are now coming due. Owners must refinance or repay. But refinancing in a high-rate environment on a property that has lost significant value, for many of them, that math simply doesn't work. Defaults become more likely, and the institutions holding the largest share of these commercial real estate loans are not the giant multinational banks with global resources. They are regional and mid-sized banks, the exact same category of institutions that depend most heavily on customer deposits to stay afloat. Does this mean your bank is going to fail tomorrow? No. Financial systems are complex. Regulators monitor these risks actively. But what it does mean is that the banking system is carrying a combination of pressures simultaneously. Degraded bond portfolios, stressed commercial real estate exposure that makes it more fragile than it appears on the surface. And both of those pressures exist inside a broader financial environment that is tightening in ways that most Americans are simply not watching. Let's zoom out even further, because this is where the story gets significantly bigger. The United States government is currently carrying a level of national debt that few people truly grasp. But forget the raw number for a moment, because what matters is not the debt itself, it's the cost of carrying it. The annual interest payments on that debt have now surpassed $1 trillion per year. The government is spending more money servicing interest on what it already owes than it spends on some of the largest programs in the country. To fund that debt, the government constantly issues Treasury bonds. Those bonds must be bought by someone. For decades, a significant portion of that buying came from foreign governments, particularly countries that ran large trade surpluses with the United States and recycled their dollars back into Treasury securities. But that dynamic is shifting. Several major foreign buyers have slowed or reversed the pace at which they accumulate U.S. debt. As foreign demand weakens, more of that borrowing burden falls on domestic financial institutions, American banks, pension funds, insurance companies, and money market funds. In practical terms, this means the financial system itself is increasingly being asked to fund the federal government's deficit. And when a massive amount of capital gets absorbed by government bonds, that is capital no longer available for mortgages, business loans, or new investments. Economists call this the crowding out effect. The government's borrowing competes with everyone else for the same finite pool of money. And when competition for capital increases, borrowing costs rise across the entire economy. And then there is one more layer. During the pandemic, the Federal Reserve expanded its balance sheet dramatically by purchasing enormous quantities of government bonds and mortgage-backed securities. That process pumped extraordinary amounts of liquidity into the financial system and helped keep interest rates pinned near zero. But in the years since, the Fed has been slowly reversing that process, a strategy known as quantitative tightening. Rather than adding money to the system, the Fed is gradually allowing that liquidity to drain away. Think of it as a vast financial reservoir that has been slowly losing water. There is no immediate crisis from this. The level drops gradually and steadily. But when you combine that liquidity drain with the government's massive borrowing needs and elevated interest rates across the economy, what you get is a financial environment that is significantly tighter, significantly more brittle than anything we experienced in the decade before 2022. And historically, that kind of tightening is precisely the environment in which hidden cracks in the financial system begin to break open. So how do experienced professionals actually watch for this? Because stress doesn't announce itself. It doesn't arrive with a warning siren. It starts quietly, small signals in obscure corners of the system that most ordinary investors never even know to look at. The first signal professionals watch is the yield on the 10-year U.S. Treasury bond. This number acts as a benchmark interest rate for the entire economy, influencing mortgage rates, corporate borrowing costs, and stock market valuations all at once. When this yield climbs sharply and stays elevated, borrowing gets more expensive everywhere. And for banks still holding those low-rate bonds from years ago, every uptick deepens the paper losses on their balance sheets. The second signal is the stock performance of regional banks. These mid-sized institutions are the canaries in the coal mine. Because they are more exposed to commercial real estate and local lending, their stock prices often begin to decline months before broader markets notice anything is wrong. When regional bank stocks start falling persistently and without an obvious cause, seasoned investors pay close attention. The third signal lives in the credit markets, specifically what analysts call credit spreads, which is the difference in interest rates between safe corporate bonds and riskier ones. When this gap widens dramatically, it signals that lenders are becoming nervous. Capital tightens. Companies that need to refinance debt struggle to do so. Investment slows. In every major financial crisis of the past 50 years, widening credit spreads were flashing warning signs long before the general public realized anything was happening. None of these signals alone is a guarantee of disaster, but when multiple indicators start moving in the same direction at the same time, yields rising, regional bank stocks falling, credit spreads widening, that combination tells analysts that the system is under more stress than the surface would suggest. And that brings us to the practical question, the one you actually need an answer to. What should you do with your money right now? Let's be very clear about something first. The answer is not panic. The answer is not to empty your bank accounts. The answer is something far simpler and far more powerful. It is preparation. It is building what financial planners call a liquidity buffer. And here is exactly what that means. A liquidity buffer is a portion of your savings that remains easily accessible outside of your long-term investments. Money you can reach and use without depending on market conditions, bank stability, or selling assets at a bad time. This concept is not new. Conservative financial planners have recommended it for decades. But recent years have reminded us, with real-world examples, exactly why it matters. When financial stress hits, the people who struggle most are not the ones with the smallest accounts. They are the ones with the least flexibility. People who have all of their savings locked inside the system, in stocks, in a single bank, in long-term investments, find themselves forced to make rushed decisions at the worst possible moment. And rushed financial decisions almost always end in loss. The standard guideline most financial professionals recommend, particularly for retirees, is to maintain between 3 and 6 months of living expenses in highly accessible form outside of long-term investment accounts. Let's make that concrete. If your household spends around $4,000 a month, that buffer would be somewhere between $12,000 and $24,000. If your household spends $8,000 a month, you're looking at $24,000 to $48,000. This is not money buried in the backyard. It's money organized intelligently and intentionally. Some people hold a modest amount in physical cash secured at home. Others purchase short-term U.S. Treasury bills directly through treasurydirect.gov. These are obligations of the federal government itself, not of any individual bank, which means they carry a fundamentally different risk profile. Some retirees also diversify a small portion into physical precious metals like gold or silver, which have historically preserved purchasing power during periods of financial turbulence. The exact mix depends on your personal situation, your comfort level, and your financial goals. But the principle is consistent, accessible, diversified, and not entirely dependent on the stability of any single institution. While you're at it, review how your deposits are structured across your bank accounts. In the United States, the FDIC insures deposits up to $250,000 per depositor per bank. That is a powerful protection, and it has worked reliably for decades. But the key phrase is per bank. If you have significantly more than that threshold sitting at a single institution, the excess portion may not be fully covered in the event that institution fails. The solution is straightforward. Spread deposits across multiple banks or account structures so that every dollar you have falls within the insured limits. This requires no complex financial product, no advisor, and no fees. It simply requires awareness and a bit of organization. Here is the bigger picture that ties all of this together. Financial markets have always moved in cycles, periods of expansion followed by periods of correction, moments of confidence followed by moments of fear. That has been true for more than a century, and there is no reason to believe the next century will be any different. What determines whether those cycles hurt you or benefit you is not prediction, it is preparation. History is filled with examples of investors who turned financial crises into extraordinary opportunities. During the 2008 financial crisis, some of the strongest businesses in America were briefly trading at prices that in hindsight seem almost impossible. Investors who held liquidity and maintained discipline during those months were able to buy quality assets at generational discounts. The same pattern has appeared after every major market disruption. The people who were positioned well, the people who weren't forced to sell, emerged not just intact, but significantly stronger. The people who had everything tied up and no flexibility were often the ones who locked in permanent losses at the very worst moment. You have spent a lifetime building your wealth. The people who protect it best are not the ones who predict perfectly. They are the ones who prepare thoroughly. Review your bank accounts. Make sure your deposits are structured within insured limits. Build your liquidity buffer, 3 to 6 months of expenses in accessible, diversified form. Ensure your broader portfolio is balanced across different asset types, so you are not entirely dependent on any single outcome. And most importantly, do this now, before uncertainty forces the decision for you. Because the only time preparation truly fails is when it arrives too late. If this conversation opened your eyes to something you hadn't fully considered before, share it with someone who is approaching retirement or already relying on their savings. The best financial decisions are always made with time to think. Make sure the people you care about still have that time. This is Global Updates 24. Stay informed, stay prepared, and we'll see you in the next one.